Good afternoon, everyone. My name is Vedant Batra, and I help lead the research and programs team here at IIC. A very warm welcome to the Demystifying Legal and Regulatory Regime for Blended Finance in India Masterclass, hosted by the India Blended Finance Collaborative in partnership with the leading Indian law firm Trilegal. The IBFC, or India Blended Finance Collaborative, is an initiative by Impact Investors Council, supported by USAID to nurture India's nascent blended finance ecosystem. We will be hosting a series of such industry discussions and masterclasses along with our partners to help philanthropic and CSR organizations like yourselves maximize funding and social impact capacity through blended finance. So why is a masterclass on the regulatory nuances of blended finance even important? Well, it's because in its current form, India's legal and regulatory ecosystem makes it very challenging to blend commercial and philanthropic capital, especially considering the diversity of stakeholders that exist. While we see some successful examples of foundations and CSR organizations participating in blended finance transactions, we see that a lot of these transactions are still very limited in number in India today. Therefore, IBFC is hosting this dialogue in partnership with Trilegal to bring to light the various legal considerations that blended finance practitioners need to account for when they design and implement innovative financing structures. The agenda for today's masterclass is roughly going to be 2 hours long, and it'll cover the following two broad themes. The first part of the masterclass will focus on increasing awareness and knowledge on laws that regulate blended finance transactions in India, such as the Income Tax Act, the Foreign Contribution Regulations Act, which is the FCRA, and also the CSR rules of 2014. The second part will effectively cover the various illustrative models of actionable blended finance structures in India. This includes social venture funds and how CSR practitioners can successfully and legally participate in them. In order to drive today's deliberations, we have with us two experts in India's impact finance ecosystem. Firstly, we will have Mr. Ramraj Pai, who is the CEO of IIC, and he'll be beginning today's masterclass by providing some broader context on India's blended finance ecosystem and also the need for a more robust and conducive regulatory regime for blended finance in India. Following Ramraj's context setting, we will be joined by Mr. Mayappa Nagman, who is a partner at Trilegal and focuses on all things tax and ESG. Maya has extensively advised and acted as lead transaction counsel for some of India's biggest nonprofit charities on areas such as impact bonds, technical assistance grants, first loss guarantees, the upcoming social stock exchange, and also other blended finance structures. We would like to thank Maya for his continued support for IBFC and also for hosting today's masterclass. Lastly, if you have any questions during the session, please feel free to note them down in the Q&A box that you see at the bottom of your Zoom interface. While we will try and answer most of these questions during the webinar, given the time limitations and also the complexity of the broader discussion that we're having, we'll be happy to share some of these responses to your questions in writing post the session, or perhaps even organize a closed door discussion for those of you who want to go into greater depth into some of the topics that will be discussed by Maya today. So thank you all once again for joining us. And now I would like to hand it over to Ramraj to begin today's masterclass. Thank you.
Thank you, Vedant, and welcome everyone. As the head of the India Impact Investors Council, it is my pleasure to if I may say, moderate this session on, the legal and regulatory framework for blended finance in India. As you are all aware, and Vedant has spoken, this is part of the India Blended Finance Collaborative, which has been begun by the India Impact Investors Council to really evangelize impact blended finance in this country. So broadly, why is this whole area of blended finance important? What is really blended finance? So, and I think maybe useful for us to just briefly talk about that. And the whole idea of blended finance is to really see whether we can move the paradigm of development finance and development funding from just saying, I created X impact. I, impacted 100,000 people. I impacted 20,000 farmers. Is it possible for us to think about how do I increase the impact per rupee that I invested? So when you start moving the paradigm from how many people did I impact or what did I create as an absolute level of impact, when we start thinking about how can I maximize the impact per rupee that I'm investing, then we start thinking about what are the ways in which I can maximize the efficiency. One way of maximizing efficiency is obviously to be better at execution. What we are presenting here is a paradigm which says, being better at execution is fantastic, but is there a way for you to also think about different funding models? different funding models which allow for a combination of possibly grants plus debt, grants plus equity, or any other form of blending, which essentially allows some concessional capital like grants to be combined with some form of commercial capital to really put more money out there on the table, so that we are able to therefore, for the same amount of grant capital or development financing, increase the absolute level of impact that we are creating. And a very high level, that is really what we are talking about blended finance. And especially in a post-pandemic era, we did feel that this is something which is very, very important for us to really, as development financiers, think very seriously about this question in terms of impact per unit rather than absolute impact. And it is in that concept that with the support of USAID, the IIC began the Blended Finance Collaborative. The idea of the Blended Finance Collaborative is to provide exposure, to provide, a lot more of, if I may say, capacity building for the market, the development financing market, whether it is CSR professionals, whether it is people from philanthropy, whether it is people from sustainable finance, whether it is people from commercial debt. How do we get them more familiar with this language? How do we get them more familiar with the jargon? How do we help them to understand that there can be different ways in which they can actually participate in this market? That is the whole idea of the Ibfc. We've done, this is, I would say, the 5th session that we are doing. Over the next few months, we will be doing almost maybe 1 session to 2 sessions per month. We've already done 2-3 master classes on basics of, blended finance. Recently, we did a session on blended finance in healthcare, where we looked at a variety of models through which blended finance can be used in healthcare. Next month, we are doing a session around blended finance and agriculture. We'll do something similar on blended finance and climate and sustainable finance a little bit later. So the whole idea is, how do you expose people to a lot of this? And as a part of this, I'm really happy that we are doing this session on the legal and regulatory issues, covering this whole blended finance market. As I'm sure many of you are aware, it's all not simple and plain sailing. Legal and regulatory is a very, very important element of the entire, sort of space. And the whole idea of this session is for us to appreciate some of the nuances, appreciate some of the issues, and also hear from one of the experts in the field as to ways and means through which we should be able to do blended finance, within the existing legal ambit. And more importantly, for people like IIC, how is it that we can work with the government and we can engage the government to evaluate whether there are some ways in which the entire regulatory framework can be simplified or can be made easier. That's the real context. I don't want to take up too much of time beyond this, but I must say it's indeed it's a huge pleasure for us to partner with Trilegal, and more importantly, to partner with Meya. Meya has been an absolute, if I may say, a veteran of the social finance and impact finance field. He's worked on multiple transactions, multiple types of structures, and therefore, I think he's going to give you a fantastic amount of coverage and examples in terms of some of the structures which could be used. What are some of the challenges with the structures? What are some of the ways in which some of those challenges could be really worked within the existing structure? As Vedant covered, we are going to cover this broad presentation from Meya in 2 parts. The first is really just an overview of what is the legal and regulatory framework for these kind of transactions. That's the first part. And the second part is going to look at a bunch of case studies and a bunch of examples. We want this to be a very interactive session, and it is my job to try and keep this conversation in a zone of, if I may say, what shall I say, interactive, stupid questioning to Meya from a very commonsensical layman perspective, from a practitioner's perspective, not so much from a legal and regulatory perspective. So we want to keep this interactive. Do keep raising your questions in the Q&A. In case some of those questions are going to be answered or at least addressed later, we will raise that. But the whole thinking is that we want to make this session very interactive, and if there is enough appetite, we could maybe do a closed door, smaller group session a little bit later. I'm not going to speak much more than that. I just want to hand over now to Meya. I will be making interventions. Some of them may be very dumb and stupid interventions from time to time, but the idea is to ask those questions possibly to Meya. And, like people say, some questions may not have answers, some questions may have answers. and we look to Maya to kind of give us the color from time to time. So please do raise these questions, because we already have 125 people. We are expecting many more people to join us. It may not be possible for us to physically put you on the screen, but please do raise the questions, and I'll try and address them from time to time. With that very sort of not so brief speech from my side, over to you, Maya. And I do hope that this is going to be an sort of innovating and interesting conversation for all of us. Go ahead.
Sure. So thanks, Ramraj. I think, Pragya, would you be putting up the presentation, or should I?
You can go ahead, Maya.
No, sorry.
Sure.
Give me 1 second. Yeah, I hope everybody can see my screen.
Yes.
Okay, great. All right, so it's a great pleasure to be here, and thanks for inviting me to conduct this. And as Ramraj said, I think idea is to kind of use these 2 hours. Happy to brainstorm even during the session and address questions as far as possible. So just moving on to the. So this was a couple of initial slides. I might just skip through, because I think this was intended for an audience who may not be very familiar with the concepts. Ramraj has already explained what blended finance is, but just very quickly orienting someone who's new to the topic as to what we are talking about. You have different forms of investing where the return expectations are very different. In traditional investing, you want market rate returns, and the traditional form of charity, there is no return expectations typically. But then we have other forms of financing where, for example, in venture philanthropy, where you want to give some upfront capital, there is technically no return expectations, but ideally you want the capital that you've given back to be able to, recycle that and put into a new project. And when you take a step away from traditional forms of investing towards something that's more impact oriented, you have something called socially responsible investing, which is the do no harm principle. When you invest in something, you try not to invest in tobacco or guns, for example. And you have impact investing that sits in the middle of the spectrum, basically, where the belief is that you can equally achieve impact and market rate returns, or some form of returns which is muted, but focusing more on the social and other outcomes that are actually being achieved. So blended finance typically, as Ramraj was saying, is, and then this is just the OECD sort of diagram, which kind of gives a framework if anybody wants to understand the jargon around this and what different forms of financing actually involve. So this is available on in the paper that we have also wrote with Ramraj and IIC earlier in 2021 or 2019. So coming quickly to the legal aspects, right now, just as a background, there are 4 or 5 laws we are going to quickly cover before we get into the structures. Now, the key sort of thinking that underlines all these laws is that when these laws were brought in 1961, much later, even although GST is a more recent law, the underlying thinking that hasn't changed except with respect to SEBI regulations is that intermixing of philanthropic and for-profit money is seen with suspicion. It's not encouraged. In many cases, it's actively discouraged in under many regulations or laws. These things, these laws view traditional forms of profit making and charity as 2 separate buckets, black and white. You make money, you set aside a portion of it, you expense it out as a charitable activity, and that basically is the story of CSR as well. But globally, and as many of you may know, the space has evolved. There are more newer forms of financing with different sort of return expectations, as I was mentioning. That flexibility is not expressly allowed, or it's not encouraged under the ecosystem of laws that we have today. So the most progressive regulation over the last 4-5 years has been whatever SEBI has been coming out with. They enabled social venture funds a few years back, and then we've seen the social stock exchange regulations come up. There's been further amendments to the social impact fund regulations now. So the intent, at least from them as a regulator, has been to liberalize this and sort of allow for blending of different forms of capital. We don't necessarily see that sort of push from income tax, GST, or from the FCRA perspective. But CSR to some extent has actually some useful clarifications have come out over the last 2 years. Some of the structures we are discussing, I remember back in 2017-18, we were struggling to kind of get some clarity around it. But now I think with more clarity, the legal and regulatory ecosystem has generally opened up. Except for maybe FCRA, I would say mostly it's been on balance a positive sort of a trend. So keeping this in mind, the 5 key things that we're going to quickly cover are Income Tax Act, GST, CSR regulations, FCRA, and AIF regulations, and maybe social stock exchange regulations as well. So income tax, very quick primer, is that this impacts particularly non-profit organizations in India. This could be public charitable trusts, Section 8 companies. This could be registered societies. They all have to get their income. Any grants that they receive is tax exempt, provided they are registered with the tax authorities. And there are a whole bunch of conditions that you have to comply with to qualify for this tax exemption. Now, there are limited items in which you can invest the money that a charity has received, and there is also requirements to expense it out towards what qualifies as charitable activities, and there are thresholds and limits as to how much you have to expense in which year, what manner of expenditure is it done, and the consequence of non-compliance with this is that the grants that you have received then become taxable, or there could be other consequences which are quite which you would want to avoid. So so this is a key thing, and there is limitations also on how much money can a non-profit charge through service fee route and how much it can receive through as a donation. So this is important from the perspective that bulk of the vehicles today, when we look at service providers, when we look at implementing agencies, when we look at who's doing the groundwork on actually achieving the impact, they are typically, majority are structured as public charitable trusts, and some of the newer entities in the recent past are structured as Section 8 companies. So that's sort of where we are. Now, going to the next one, GST, this came out in 2017. Now, the key takeaways under GST are that there is only limited sort of exemptions for certain activities that charities undertake, or based on services they render or they receive. So generally, it's not like charitable entities, their activities are exempt from GST. In many cases, the compliance obligation and the burden can be quite burdensome for bulk of the non-profit organizations, unless you are a bigger sort of entity and you're okay with that compliance burden. Secondly, for-profit entities usually are subject to GST. Their activities and services are subject to 18% tax. Now, in some of the structures where we are going to discuss further down, one key issue that will come up is when we are shifting slowly from traditional grant making to outcome-based grants. So you will have a list of deliverables, you'll have a list of outcomes, outputs, and then there is a money that is coming at the end of achieving that outcome. So one common question or risk that always comes up is that then can this grant be considered a service? And why that matters under GST is that then you'll have an additional 18% sort of cost on the gross amount, which is a big hit. There are many structures we have seen in the past that have kind of not worked because of the GST or tax implications, where the IRR goes down or it just becomes not feasible. Secondly, then the one other point is that sometimes export of services or may not be subject to GST in India if we are structuring any of these contracts as services to foreign entities, foreign non-profits, or foreign risk investors, right? But there could still be a VAT applicable in the foreign jurisdiction. So I'm not going to go through the key takeaways and issues on this slide. We will get into those on a structure by structure basis when we go through each of the models that we have set out later. Now, AIF regulations, this comes under the SEBI purview. So AIF is an alternate investment fund. It's a pooled investment vehicle where different investors can put in money. There is usually a fund manager. This is typically structured as a trust, not a public charitable trust, but a private trust, which issues units to the investors. And the trust or the fund, once it has pooled all the money, then there are requirements under the regulations that you have to invest at least in 4 different projects, and you'll have to, and based on the manner of investments, if you're category 1, you can invest in certain kinds of instruments or entities. If you are category 2, then you can invest in broader range of instruments, and you can probably even do debt. So depending on your manner of investment, your returns, whatever comes, is taxed in the hands of the recipient, and the fund is basically a pass-through for that. So here, primarily the key one for us is under category 1, there is the social impact fund. This was earlier called the social venture fund. They primarily, so this was one of the first regulations, progressive regulations, which allowed blending of different forms of capital. You could this entity can actually receive grants under the SEBI regulations from non-profits, and can also provide grants out as well to non-profits. They look at whether you can invest into social ventures or social enterprises. Now, the definitions of this and all are also set out. Typically, these are a combination of for-profit and non-profit entities which are focused on the making an impact. Social enterprises, of course, derives its definition from the social stock exchange regulations on the amendments that came in relation to that. So there are slightly higher thresholds for an entity to qualify as a social enterprise, which could again be non-profit or for-profit. And we will get into some of those at a very high level quickly in the next couple of slides. Now, some of the recent amendments have also enabled. So earlier there used to be questions around, can investors make muted returns or not? Does it mean it is necessarily muted returns? There was some kind of doubt around that. Now you have social units which investors can invest in. And where it's expressly said that such investors can agree to receiving only.
Maya, 1 second. I have a small question here, Maya, for you.
Sure.
Which is, I'm sure, in the minds of many people. Can I, in an SIF, blend different forms of capital? Can I take grants? Can the SIF also take debt and/or equity, or is it only a grant in, grant out structure, or a grant in and investing structure?
So SIFs currently, you can take grants in. Once you receive a grant, it will, under the SEBI regulations at least, right? And we will get into tax, FCRA. Anyways, it has to be in compliance with other regulations as well. But under SEBI regulations, yes, SIFs can receive grants. They can also grant out. They can also receive grants and use that money to further invest downstream into securities or partnership interests of social ventures. Or
can they also take equity and/or debt?
No. So SIF can only take a loan for working capital purposes, and they cannot take investments. They can only issue units, against which they will take capital contribution for pooling purposes, but they cannot take equity or debt. They will invest into.
So they can take a capital contribution and/or a grant.
Yeah, correct.
Okay, got it. Okay, sorry, go ahead, please.
So, yeah. So meaning of social venture is slightly different from social enterprises. Social venture is that, these entities are focused towards improving social problems or providing social benefits. Now, the thing is, these entities are both for-profits and non-profit, and there are many different types of, while the regulations say you can invest in securities and partnership interests of such entities, some of the entities, if you see on there, which qualifies a social venture or a social enterprise, like a public charitable trust or a registered society, under the current regulations cannot actually issue any sort of instrument which qualifies as a security or a partnership interest. So there are a few gaps. Yeah.
Yeah.
And that's something that we'll be looking at during, when you look at the structures and see what's actually doable and what's not doable. Now, coming to CSR regulations. Now, this is something which kind of, globally speaking, CSR is seen as conducting the activities. It's more akin to ESG, where you look at how you are doing the activities in a sustainable manner, and you incorporate in your business operations principles of running it in from a stakeholder perspective and taking all of that into account. But our CSR provisions are still kind of reinforcing that older school thinking that you have profits, you set aside a portion, and it's usually has been expense oriented since its conception. But as I said, recently there have been, thanks to efforts by industry bodies and many stakeholders, I think there has been a liberalization and further clarification in what CSR can actually be used towards. And we have seen certain, so this is an obligation for companies to set aside a portion of their profits every year and to use it towards certain purposes set out in Schedule 7 of the Companies Act. Now, there have been, as I said, certain kinds of, when we look at outcome funding structures, when we look at, where payments are tied to outcomes happening, I don't think there is a question on the commercial side that it is actually a better form of financing compared to traditional grants in many cases, because you have the ability to show that the outcomes have been achieved prior to the payment being made. So, but however, from a legal and compliance perspective, this has raised a lot of questions in some of the work we have done over the last few years. So, if the outcomes are not achieved and if the money is therefore not spent, then how do we sort of carry it forward, claim it as an unspent amount? What about the compliance and explanation around that? And the regime has actually changed over the last few years as well. And you kind of see also, I think earlier, what qualified as administrative expense, etc., was a big concern in terms of setting aside money for certain projects or the way it was to be done. But we have seen some clarity come through on that as well. I think one other issue that comes up a lot now is many of the board of directors usually for an ongoing project can give an approval for up to 3 years for running a project under CSR. But many of the instruments we deal with sometimes have a 4-year, 5-year sort of a timeline. And when you are an outcome funder and you are a CSR, so sometimes this is subject to additional approvals by the board, and how do we sort of commit to it upfront? I think those sort of questions still do come up. FCRA, I think this is the one regulation. So FCRA basically, governs the cross-border receipt or payment of grant money by a foreign donor or a party to any Indian resident. And specifically, there are restrictions that this money cannot be received by an Indian party without prior approval or a registration with the Ministry of Home Affairs under the FCRA Act. There is tight regulations around this in terms of how the money should be received, how it should be reported, and which banking channels should it be received, etc. So, and then unfortunately, so FCRA is the kind of law where, under the technical wording of the law, any foreign donation from to a non-profit or a for-profit in India could also be covered. In many cases, I think expressly service fees are not covered under this regulation, but FCRA is the kind of area where it's very regulator driven. So you have to really look at the facts and the substance of the structure or the transaction to kind of assess how the regulator is going to look at it and kind of take enforcement action. I think what we have seen over the last 5 years is that it has been getting more and more stringent. The regulations have gotten more stringent, and the regulatory actions have also, they are really looking into the substance very closely. So we have repeatedly seen questions as to whether certain kinds of transactions can be seen as disguised grants, or whether even what comfort is there within the service fee route on substance. So it's extremely fact dependent, it's project dependent, it depends on the area in which the activity is being undertaken. It also depends on whether certain types of funders are are being monitored, or their funds are going towards certain projects, and whether by being associated with that, does anything else get impacted on our delivery, right? So there is a whole bunch of subjective issues that keep coming up. Another thing that I've also noticed is that, as a practitioner in this space, because the enforcement is so fractured, so to say, right? I don't think any one person has the full visibility on what MHA authorities are doing at any given point in time. So I've actually had clients come back and say that they have received entirely contradictory advice from different experts, because in some cases certain activities are getting investigated, and sometimes it's very difficult to have visibility on this unless you are directly engaged on such sort of an activity. So the kind of enforcement actions we're seeing on ground, I think it's actually good to speak to multiple people and get a sense, because it's really very enforcement driven by the MHA on this. And we'll get more into that when we get into the structures. Sure.
Quick question. I think a couple of thoughts. Natural questions is, what is the under the so is there a view that in an SIF, does the SIF also need an FCRA approval if they want to receive a grant? What is the present view that you have on that?
Sure. So I think, so let's just take a step back and say that, FCRA technically governs, as I said, the provisions are broad enough to cover donations to private entities as well. So while historically the enforcement actions were only in relation to, a non-profit abroad giving donations to a non-profit in India, I think there has been some sort of recent movement around even for-profits receiving funds, which may be in the form of grant, or there is, I think, increased perception of risk even if they are receiving service fees as well. In between, related parties were the main area of concern, but now we are kind of seeing that move to even when the parties are unrelated and receiving sort of service fees towards, and that comes down to the kind of activity that's being undertaken as well. So in this context, if we look at the social venture fund, so our social impact fund, technically it's structured as a private entity because it's a private trust. I think, but while the activities are mostly on the investment side, and it's usually into, either social enterprises, which because of the SSC regulations will have a 67% spending expense or income from serving underserved, population and target areas, or will have some kind of a social impact purpose that it's trying to solve for. But whether the second we say that social impact purpose, it gets somewhere into the charitable domain, I think there is a risk that MHA authorities can come and say that this is something that should have fallen under FCRA. I don't think we can entirely write off that risk. But if we can say this has nothing to do with charity, nothing to do with any political lobbying or any area in practice which the MHA is monitoring or wants to monitor where the funds are going, maybe on a very fact-dependent situation, we can try and say that the risk is actually on the lower side. We still can't entirely rule out, but I think we can say that it's a low to very low sort of a risk in that case.
Other question, Maya, is like this social impact fund, it doesn't seem to be a very popular structure. We don't, at least I haven't heard of too many SIFs. Is it because development funders have not been very creative in thinking about this whole idea of moving grants to, sort of more, sort of the, or is it just something exotic that people have just stayed away from? Or what is the reason why, say, structures like SIF haven't been as, at least I haven't heard of too many SIFs in this country?
That's a great question, because I think, as I said, I think 2017, from 2017, we have seen a lot of interest. Every time the discussion always goes back to some form of a fund or a large platform which can enable pooling of funds from multiple sources, philanthropic and for-profit, and allow for that sort of syndication and giving the returns back to the investors as well. And through the years, I think we actually came up with one or two innovative structures which maybe legally we cracked it. The practical challenge and the real takeaway and learning on that was that usually when you're trying a innovative structure which is being done for the first time, there is obviously no Supreme Court ruling which says that this is entirely kosher in accordance with law. There is at best legal opinions that law firms issue say that at a should level it's about 70% certainty that this is what the court will uphold. Like nobody does give a legal opinion at a higher comfort level than that. And that was okay for the for-profit investors who are, for them it's an acceptable level of risk in undertaking a transaction. But for non-profits, I think the regulatory, like non-profits who are involved in these sort of structures were generally of the view that financial risk is okay, but reputational or regulatory risk was an entire no-go. So the risk appetite wasn't there to test a structure which was so out of the ordinary or not in line with 2-3 different new things we were doing, and didn't really want to test the market with that. Now this is also despite the fact that FCRA technically is an issue, is a requirement for the recipient in India to have this registration, and any sort of issues will be in relation to them legally speaking. But of course there could be secondary implications where a foreign funder could be put on a watch list. There are other projects that they are funding in India could be monitored and could face issues. So we do we understand the reasons why there has not been much of a lot of interest, but actual action has been quite conservative because of the regulatory regime and the lack of clarity surrounding that, or the risk associated with it.
Got it. Let's move ahead. There are a bunch of other questions coming up, which I'll take up from time to time, but you can move ahead. I'll curate it. Some of the questions, guys, you have been raising, I think, around issues like returnable grants. What is the tax treatment of that? Can CSR be used in returnable grants? Jasmer has asked a question. Some of that we will take up in the structures that Maya will discuss. So my request is please hold on. We will take some of those questions live as we go into those areas. I'm just conscious that, we just want to follow the structure. Otherwise, this can become a very, you can just go all over the place. But I am taking these questions. So Jasmer, Tejas, I think we will try and answer some of these questions as we kind of move along. Yeah, go ahead. Yeah.
Sure. So as Ramraj was saying, I think we are close to the last 2-3 slides on the background to the key regulations, and then we will kind of see on different structures how they overlay on top of each other. Now, the social stock exchange, this is another good move that the SEBI has come up with. They've made changes to 3 different regulations: the ICDR, the LODR, and the AIF regulations to bring about this sort of a change. What this allows for is basically, at a very high level, 2 different sections or ways to list on the on a current exchange. So non-profits can list on the social stock exchange, and for-profits can list on the SSE, but in addition to any other arm of the exchange that they're listing on, they'll have to comply with those requirements as well. There are different sets of instruments that non-profits and for-profits can list. For example, non-profits are technically under these regulations allowed to issue 0 coupon, 0 principal bonds, where basically you don't have to return the money, the principal, nor there is any interest payment in it. Now, to qualify and to register or to list on the social stock exchange, to list any instrument on the SSE, you have to either be a non-profit organization or a for-profit as set out on the rules, which also qualifies for the so having a social intent, and which is determined by one of the 3 criteria, which is that in addition to serving underserved or less privileged populations, and they have and acting in one of those 16 areas that they have set out, you should also have at least 60%, 67% of the activities that that body conducts targeted towards the target population, or the income that you derive should be, 67% of it should be from serving that population, or 67% of your expense should be incurred towards serving that target population. So they have come out with a lot of listing and annual disclosure frameworks. So at the time of listing an instrument, or on an annual basis, whether you list an instrument or not, depending on the type of entity, there are multiple, disclosure requirements. And this goes into, multiple sort of questions around your what is the intent, what is the policy, how are you benchmarking it, what is the impact scorecard, what is the base, what was the base at the time you started benchmarking, how much improvement has happened. So there is a whole bunch of compliance things that we'll have to do this. And primarily the fundraising options, which is the key thing from a structuring perspective, is for non-profit organizations, is through the zero coupon, zero principal bond, donations through mutual fund schemes. And they say that anything else that is issued, notified by SEBI from time to time. Some of these bonds and instruments can also be issued through private placement, which means it can be done off market as well. For-profit entities, it's usually what you do is debt and equity shares is what you can mainly do. There is a whole bunch of practical difficulties, which I think we will get into when we get into the structuring aspects and see where we run into problems. The one last regulation that comes up also is...
Before we move to FEMA, I just had a broader question that since the early days of the design of the social stock exchange, is there any cross-referencing to either FCRA or IT Act or anything else that has happened other than the standalone regulations, which, obviously SEBI has issued? Is there any progress on any of the other things, like the questions you're raising around, can philanthropies invest in this? What will be the tax treatment? Is there any cross-referencing which has happened at all since the initial days?
So, no, to the best of my knowledge, I don't think so. I think they are mostly only on the regulatory side. But one interesting document, I think, which will, if people haven't seen it, might be of interest, is the FAQs issued by the National Stock Exchange. So they are the ones who've gotten the in-principle approval, currently from SEBI to set up the social stock exchange. And the FAQs issued by them actually talk about 2-3 interesting things. One, they say that the tax treatment of the zero coupon, zero principal instruments should be equivalent to that of donations in accordance with the accounting standards. Secondly, they also say that, specifically on the question whether FCRA, etc., will apply, they say that for investments from foreign entities will not be accepted for instruments listed on the social stock exchange. So that's going to be an interesting thing to see, because I think the main interest was, typically in this space, from what we have seen, bulk of the funding does come from, offshore outcome funders or charities. So if that's not going to be allowed on the SSE platform by NSE, and it's mostly the domestic market, that I think maybe it's phase one, maybe that's what they're enabling, because that's clearer and easier to do from a regulatory perspective. But that, I think what we are looking forward to now is primarily these instruments being popular within the domestic market. I don't think, I don't get the sense that this is going to be something that the foreign funders will be able to directly participate into.
But even within the domestic market, Maya, there has to be some clarity as to whether charities and other people can invest under the ambit of their, charitable kind of the Charities Act, as well as whether these are allowable from their tax exempt nature. Those two, definitely you need a clarity. Even if you assume that right now it's only open for domestics, that clarity will still be important.
No, you're absolutely right, because as I said, as you correctly pointed out, there is no government or regulatory entity which has come out and said this is the tax treatment or this is the nature of the instrument. Now, obviously, as a listing platform, NSE, they will come up. The way the SSE will work is that somebody who wants to list a zero coupon, zero principal instrument will have to take a draft of a document, have it vetted by the stock exchange, and then, based on their feedback, I think based on their FAQ, at least it seems clear that the nature of the document and the underlying transaction in their view should be treated as a donation. So if it's ultimately seen as a donation, maybe then there is some comfort to be drawn from that, and from a tax that's how it will be treated. And maybe it should qualify as a charitable expense, but we'll have to again see what is the project, who's giving it, for what purpose. And ultimately it's going to be a new form of documentation, which, while there is some comfort that NSE views it, and once they have approved it before listing, I think we can take some comfort from that, considering how closely NSE also works with the government as well, right? But there will be a point where the entity, whoever is listing, their auditors, lawyers, everybody will have to get comfortable that ideally, as you rightly said, a clear clarification under tax law would have been ideal. But all of us will have to get comfortable around that sort of documentation, that it passed the test and it doesn't get questioned by any assessing officer when the the assessment happens later in the year.
Got it. Go ahead, Maya. I think we should move quickly now.
Sure. So quickly on FEMA, I think the one thing, so again, cross-border debt investments, this comes up in different contexts, different sort of structures. One of the key things is that, under the ECB framework, 2-3 problems come up. Under the ECB regulations, there is a certain sort of restrictions around who can receive loans or point happens to be the minimum maturity period, which means that once the money comes in, then it cannot be returned for at least 3 years. And depending on the end use, what you use that money after taking the loan, it can go up to 5 or 7 or 10 years as well. And in many cases, certain end users are entirely restricted, and so that becomes a problem in terms of who can receive this money, and practically whether certain Section 8 companies involved in charitable activities, can we do it, or is there even a way for public charitable trust to do it? So those sort of questions do come up. The one route that has actually worked, and we have seen in the market, is the structured obligation route, where basically a foreign entity provides a guarantee to, let's say, a bank in India, against which the bank kind of gives loans. And if there is a write-off, or if somebody doesn't repay, then they trigger the guarantee. So this comes under the structured obligation route. So this is something that we have seen actually come through, where the guarantee is given by a non-profit or a DFI. So that leads to some sort of blending of finance. So coming to the illustrative structures very quickly, right? We're going to start off with a little bit of the easier ones, so to say, and we'll build up to the more complicated ones. The outcome funding structure. This is a very plain vanilla outcome funding structure. So we have an offshore outcome funder, typically.
So broadly, Maya, before we get into the structures, I just wanted to take a short kind of a summary. So broadly, the way you have summarized this, there are 4 broad heads of issues. One is really around the tax treatment for the investor, which could be a local philanthropy or otherwise. What is going to be the nature of the tax treatment, and whether this will impede their tax exempt kind of status. So that is one big head. The second big head is the nature of the receiving vehicle. Is the nature of the receiving vehicle such that they can be FCRA exempt, or do they need FCRA, and so on and so forth? So the nature of the investing vehicle, the tax treatment of the investor. The third is issues around CSR, which are really what CSR can do and can't do. And I would say the fourth will be around issues around GST, as to whether a granting structure can be construed as a service and therefore will be eligible for GST. To me, broadly, it looks like, and then obviously you have FEMA, but which is really linked to ECBs and MAMPs, which I'm for now keeping a little bit aside. But broadly, it appears that, can the investors from a tax treatment do this? What is the nature of the receiving vehicle and their sort of status, CSR, and the fourth would be GST. Would I be right in saying these are the 4 or 5 broad heads under which the issues come up? Because even when we look at every of your slides, it will have these 3 or 4 broad heads. Can I kind of just sort of summarize it before I allow you to go ahead on this?
Yeah, that's an accurate summary. I think those are the issues that keep repeating in different contexts and forms, permutation combinations across the different structures. And of course, there could be structure-specific regulations.
Absolutely, absolutely. But just for the benefit of the audience, I think these are the 4 broad heads. The guy who's giving the money, I mean, will anything he do impact his tax treatment? What is the nature of the vehicle which is receiving the money? Is it FCRA approved or not? Is this allowable as per CSR? And second is, if I am as a philanthropy or a CSR giving money, is there a chance of GST impact at 18%, which is a huge leakage? To me, broadly, these are the 4 things. Your SSC and the others are kind of incrementalities of something around these broad structures. Over to you again, Maya.
Sure. So I think just before we...
Guys, just for the clarity of everyone, we will have a slide on social venture fund. We have a slide on social impact fund. We have a slide on returnable grants. There is a bunch of questions that people are asking. I'm just waiting till those slides come. And I'm sure you will already see some of those questions on those slides. So, I'm sure Maya will answer those questions from there. Over to you, Maya. Sorry.
So maybe I'll just quickly skip through the 8 structures we are doing, and then I'll get into the details of it. So the first one is a pure vanilla outcome funding structure. The next one is an impact fund structure, where it's a social impact fund. The third is we're going to talk about returnable grants. Fourth is impact bonds. Fifth is social success notes, social stock exchange, and we have the category 2 sort of fund structure, followed by the structured debt obligation structure. So we're going to go through all of this, and we will happy to take questions and discuss these things in detail as well. Starting with the outcome
even with the questions, guys, if you're discussing outcome funds, if they have specific questions on outcome funds, we can take it then and there. And then maybe once we go to the next slide, if there are specific questions there, then it will help us, because now if you ask me on the last slide wala question, it will kind of, in the flow of the questions, we may lose it. So I would request, wherever people have specific questions on, say, this slide, which is outcome funds, please put it right now. We'll take it up immediately. Over to you, Maya. Sorry for all these.
No, that will be perfect. That'll actually be good also. So I think from a outcome funding, plain vanilla perspective, what we have put out here is that you have a offshore outcome funder, you have a onshore outcome funder, who could be a CSR or a domestic charity, and we have the risk investor who puts, who funds the implementing agency or the service provider who's achieving impact on the ground, either through a service fee or a grant. And I'll just take you through the permutation combinations, right? Because there could be multiple sort of consequences for each of this. I think once we have these basics right, then it becomes easy to layer on, because as Ramraj said, some of these are common issues across the other structures as well. So we'll be looking only at the incremental issues there. So when we look at, first of all, risk investor giving service fees to a for-profit entity, that's, there is a 18% GST on it, but that doesn't usually become a cost, because being a for-profit entity who's providing the service to the risk investor, they may charge an 18% GST on it, but they get the credit of it. So it doesn't end up being a pure cost to the for-profit entity, and they are able to set it off. Now, ideally, then you want to be able to give a grant to a non-profit organization who's an implementing agency. So from a receipt perspective, if you are a Section 8 or a public charitable trust, receiving a grant is actually the best way to do it for you from an income tax perspective, where you say that this is tax exempt income, provided you spend it for that particular sort of charitable activity in that same year. Now, one thing to note is that the non-profit organization, the market practice on how this is actually treated on the accounting side is extremely sort of, it's driven by the CA, by their in-house accountants and what they have done historically, and there could be multiple types of treatment. So for instance, there is a difference in treatment between tied up grants and grants that are otherwise, don't come with too many onerous conditions, for example, right? So, and these are all mostly based on court rulings, so which is where the sort of difference in treatment comes. More or less, the end result is the same, but in some cases, it becomes important to pay attention to how this is being done. Now, let me flip it the other way around and say, because this risk investor, we have not defined whether it's a for-profit or a non-profit entity. And risk investors typically put the money upfront, right? So it could even be a non-profit giving grants upfront and in a way assuming the risk on that money that they are giving. Now, if you take it as a for-profit entity, the risk investor, giving a service fee to the service provider below becomes easy. But it is unusual for a for-profit to give a grant to a non-profit, right? There is a higher risk that will be seen as a service fee or some sort of service arrangement with a non-profit organization. Also, additional risk can happen because you have two entities. One is for-profit and other is non-profit doing the same outcomes or achieving the same outputs. And one is structured as a service fee and other is structured as a grant. So that increases the audit risk and the perception of a grant, actually being recharacterized or seen as a service. This has to be seen from two perspectives, right? One is, of course, the main tax authority who will see the grant as a service in that case is your GST authorities, because they are the ones who are going to come and say that 18% GST should have been discharged on this amount. Now, unlike the for-profit entity, the non-profit organization will not be able to make use of any GST that is paid, because if they are already not registered for GST, registration and compliance is a huge cost and compliance burden for them. Secondly, they don't typically have any other sort of input services or other things or output services to kind of set off this GST credit against. So it ends up becoming a pure cost for them. And typically, if something has been claimed as a grant and the GST authorities have a 5 to 7 year limitation within which they can come back and question the nature of the transactions, by which time they've already achieved the project, spent everything out. So they'll have to go out of pocket to pay the 18 rupees at that point in time. So the risk actually is a lot more on them. Now, the other risk that they will also face is from an income tax perspective, where there is a limitation as to how much money a non-profit organization can accept through the service fee route. So typically it's prescribed as up to 20% of the total amounts received in a year can be through the service fee route. So if this becomes recharacterized as a service fee for whatever reason, then you kind of are in a situation where you're seeing based on the quantum, are we breaching the 20% threshold or not? So these sort of issues can come up. Now, if we say that the risk investor is actually a non-profit, then giving the grant becomes easier. But to what extent can that risk investor give service fees to a for-profit entity, right? That again becomes an extremely fact-dependent sort of exercise. So,
Maya, in the interest of time, there are a couple of questions. If you just want to look at the Q&A that you can see, just want to take it up. I think I think there's someone who wants to know who's the risk investor. So maybe you can just give an example. And also, Umang is asking that the RPTs, I'm not sure what RPT means, but will apply for profit and not profit, and even risk investor for that matter. Please shed some light on this. So there's just a couple of questions. You may just want to explain broadly what the risk investor means. I think some people may not even have a sense of how the outcome funding. Very quickly, I think you can touch upon this.
Sure. Sorry. So risk investors, right? Just very quickly, conceptually, who is a risk investor, who's an outcome funder? So this kind of outcome funding started off as a project in the UK, where they said that somebody who's willing to finance a project upfront and assume the financial risk will be considered the risk investor. So if the outcome is to, let's say, get 100 children, right? The risk investor says that I will put in the 1,000 rupees of upfront capital. I'll take the risk in doing this, and I will find the correct implementing agencies who can go and educate those 100 children. And only when that outcome is achieved will the risk investor receive any money from the outcome funder. So if the outcome is not achieved, then basically whatever money the risk investor has put in towards these, service fees or grants to the implementing agencies will be written off. So it's entirely a loss for them. So this is how a in theory, what an outcome funding structure looks like, because you have a risk investor putting the capital in, selecting, and because the risk is entirely on them, there is a high financial incentive that they will pick the correct implementing agencies, and that increases your chance of achieving the desired outputs. And the outcome funder gets the comfort that by the time they make a payment, the outcome is already achieved. So it's not like a traditional grant where you give the money and then through contractual rights or through disclosure and other monitoring rights, you have to see what is happening on the project. So
very quickly, Maya, I mean, from your perspective, if you were asked to design a structure like this, what is the ideal risk investor? Who could be the ideal risk investor in a market situation like India?
It really, again, there is no ideal. I think there is, because of the way the regulations are split between for-profit and non-profit, because there is a bifurcation between how for-profit money should go and how non-profit money should go. Normally, what we tend to do in structures and what we have seen happen in practice is that, clients come to us and say, okay, we have shortlisted these, set of entities who are the implementing agencies, which is a mix of non-profit and for-profit entities. This is the list of outcome funders that we have listed, who could be onshore, offshore, government, whatever. So, and then we start looking into what is the correct SPV to sort of route these money in and out and do it. We've had to do hybrid structures, to be very honest, because sometimes the payments may directly flow from outcome funder to the non-profit, or have like I don't think there has not been any structure which has been identical to the other. Maybe some contracts such as the service fee contract or the outcomes-based grant contract template might be the same, but otherwise the entity through which who acts as the risk investor has been entirely structure dependent. It comes down to what vehicles the parties also have at their disposal, right? Usually, and we usually look at whether can it be a non-profit, can it be a for-profit. Sometimes we have also had to drop certain implementing agencies because there was a risk involved in sort of funding the agencies in this form of a model.
Okay, I think quickly, Maya, we'll have to move. I think there was one question around related party transactions in the case of for-profit, not-for-profit. Is there anything at all that you can comment on this? There's a question from Umang.
Related, see, there is an obligation under law when a non-profit is transacting not just with a related party, but even with any other for-profit entity or party when they are implementing a project. There is a fiduciary obligation on the, like, let's say if it's a public charitable trust, the trustees are under a fiduciary obligation to ensure that they are paying they're not paying exorbitant fees to anybody else in achieving those outcomes. So I think that risk will be more heightened if there is a related party transaction, because then there is an obligation on you to make sure that you are actually getting the bang for the buck.
Yeah, let's move ahead, Maya. I think we have 7 more structures to go. So I'm going to keep a bit of time in the interest. I'm sure lots of people can mail you directly and get clarifications, because as you can appreciate, every structure we can spend 1 hour on it and we may not reach the end. Let's move on, Maya.
Sure. So I think, and some of this will come up in the next one as well. So we will take up impact funds next. So here, this is what the market generally gravitates to, which is that you have risk investors offshore and onshore. They usually purchase units in a social impact fund. Based on the recent regulations, you also have the ability for certain investors to buy the social units where they may not get any returns as well, which may actually be of interest to foundations which are based abroad, because foundations in the US, for instance, can invest up to 5% of their corpus through the PRI route, which is the project related investment route, and they can make actual investments where the returns are negligible or less than market rate. So maybe that's an avenue that opens up based on the recent sort of amendment. Historically, we tried structuring something like that, where we issued a different class of units, which was lower in the waterfall. But I think one question that came up from the US Foundation's perspective, and which may come up again with respect to these social units, is that what do we do with this on our balance sheet at the end of the day? Because these funds, the social impact fund, can be there for 7 years, 8 years, for a long period. And there is no return expectations necessarily from these social units or these sort of units. So it's just like a dead asset sitting on the balance sheet, and that wasn't something that foundations were comfortable with. So I think that's something we'll have to see. The second thing is, now you also have technically the social impact fund, as we were discussing with Ramraj, can accept grants. But if you see the diagram, we have not really suggested that in that sense, because a CSR foundation or a public charitable trust in India, if they have to give a donation to a social impact fund, while SEBI regulations allow it, the question is from a CSR or from an income tax perspective, if they are giving a donation to a private trust, which is then going to use it as corpus for investment into a PLC or an LLP, whether that will qualify as a charitable expense is a gray area, right? There could be questions around that. Of course, one way to defend that potentially is to think along the lines and say that, okay, this is invested only into social enterprises, which are clearly serving, some sort of larger impact or are qualifying as a social enterprise under the SSC regulations, and therefore, whether that helps us say that this is actually a charitable expense or not. But as I said, practically speaking, considering the risk profile, I think it will have to be a very deep dive analysis whether that will work out. Now, the alternate way of doing this, if you can't directly do it with the, give the outcome funding to the social impact fund directly.
If I may stop you here. Here, the private limited company, the CSR foundation, so you at the bottom said that the arrows are the transactions, and then the other line is the ownership. So it looks to me that it is owned by the risk investors, and by the offshore foundation. That's the structure.
Correct.
Other blues, which are CSR foundation, public charitable trust, what is the nature of those? Are they investing into the social impact fund, or they are recipients of the money?
No, they are outcome funders.
Okay.
And I was just saying why, normally it would have made sense to directly blend their fund into the social impact fund itself, considering the SIF rules allow it. But there could be tax issues for the foundations in claiming it as a charitable expense. And secondly, once the money goes into the SIF, there is no way today to directly pay that as a return to risk investors. So it will still have to come down as an investment and then be repatriated, which becomes very difficult. So that becomes unworkable. So the other way to do this is to have the outcome funders pay it as a service fee to the LLP or the PLC. And after payment of taxes, etc., they will upstream it as dividends, which will then be received by the risk investors. Only downside is, again, there is an 18% GST cost on structuring this as a service fee, and that fiduciary obligation would apply to try and optimize costs. And the preference generally for charitable foundations is to do it as a grant, and which can result in certain tax consequences for the PLCs as well. I mean, they can technically, there is a way for private limited companies to receive grants and also kind of net it off as an expense and optimize the tax cost. In some circumstances, it results in a gift tax, but I think in these cases, you can claim it as an exempt income or expense it out and optimize it. So that route is still available.
Okay, so basically the foundation is essentially the outcome funder, and these CSR and public, they are the outcome funders, and then you have the risk investors.
Correct.
Okay. Got it.
Yeah. One limitation is this social impact fund, being a category 1 fund, cannot invest into debt instruments. It can invest only into partnership interests or securities of social enterprises. Now, as I said, so basically that comes down to PLC, and which is a private limited company, and an LLP, or a Section 8 company at the most, because other types of non-profits cannot issue instruments, and debt instruments are excluded under this route.
Okay. Yeah.
So coming to returnable grants, right? Now, very simple sort of structure. There's already precedent for this in the market. So CSR fund or CSR funds are given as a donation to recipients, which could be individuals, other charities, Section 8 companies. We've just kept it very simple for the purpose of this diagram. Now that grant does not come with a legal obligation to repay, right? Abroad, when you say in the US and stuff, this is a form of venture philanthropy where the money is given with the expectation that once the recipient is profitable and has recovered that money, they pay it back, and it allows the donor to kind of recycle that fund and give it forward again. But I think the market practice here, in line with the law, is that it's given out as a grant with no legal obligation to repay, but a moral obligation to repay it. And from what I understand, I think there has been a high percentage of repayment by people who have actually received these funds as well. So that seems to be functioning in practice, but legally, can you go and say that this is something that you have to pay back? No, that's not possible. See, the fundamentally in law, a grant is something that is given without any return expectations. So even under the SIF regulations, there is again mention of when grants are given that there should be no return expectations, and it's kind of just given away. Technically, to some extent, under even existing grants, you will have certain clawback clauses which say that if it is misspent, if it is not spent correctly, or if some amount is remaining unspent, it's only in those limited circumstances is the money to be returned to the donor. Otherwise,
just to hold on here. So just to be clear, the CSR fund gives a grant to the Section 8 company.
Yeah.
The Section 8 company invests it in something, whatever, and possibly whatever money it has given is generating something which is coming back to the Section 8 company. Is that an appropriate way to think about it? Now, the Section 8 company is getting back some of the money which it has used for whatever charitable purposes. Maybe it has used it, to support some people, during a pandemic, and maybe some of the people are returning that money. Now, the Section 8 company, you are saying will give the money back to the CSR provider? Is that the structure? Yeah,
that's the moral obligation. So it's a how do I say? It's not a legally enforceable understanding.
That is okay, but if the Section 8 company is going to give back the money to the CSR, is a CSR foundation or an organization in a position to receive that money back? Is that allowed as per the returnable grant? Forget the legal obligation. I have given you 100 crores. You have used it in some fashion, and you have realized that 100 crores the people for whom you gave this money, they said, hey boss, it's great you gave me this money, but I didn't need all of it. Life was better for me. I'm giving you back 50 crores as a bunch of, let's say it's a bunch of self-help groups or whatever. You gave the money, some of it came back. Can I give this money back to a CSR foundation? Is it allowed for a CSR foundation to receive back a grant that it has made?
I think it should be fine, because and one of the FAQs I would rely on the clarifications that came through last year. See, in all these outcome funding structures and in relation to this sort of where there's a receipt by the donor when they're acting as a risk investor or as a recipient of these funds, I think we typically go down that FAQ which says that any surplus that is received by the CSR fund has to be reinvested into the same project or carried forward and kind of put into the unspent account, or you can use it for basically any other CSR purpose. That's what I recollect. So any surplus also includes surplus from any interest from money sitting in the bank accounts, or because of disposal of assets, or because of any activity CSR has done, it receives money back. So surplus is pretty widely defined. So I would think under that clause or under that protection of that FAQ, CSR funds should be able to do this.
So can the Section 8 company issue debt, and let's say 100 rupees of debt, 50 rupees only received back because other 50% no one paid up? So can that money go back, that 50 crores to the CSR fund? Is that a possibility?
Yeah, that should not be a problem. I'm not getting into how the Section 8 company, gets the money. So it could also be undertaking a charitable activity, receiving outcome funds, replenishing the money, right? It doesn't have risk investment capital, takes it from the CSR fund. But once they get it back, they can upstream it back. That's not going to be a problem.
Okay.
that will be considered from an accounting perspective as a fresh donation by the Section 8 company into the CSR funds.
Okay.
Yeah. So one thing that I have forgotten to address in the general slides, which is actually the big change suggested in the budget this year, and I think it's important that we address that, is that there's going to be a limitation on how much of the grant that is given or sub-granted, right, or further onward granting of grants. You only get 85% of that grant amount as a charitable expense. So that's going to create quite a bit of friction in terms of some of these structures, because every time, right now, CSR fund gives a grant, let's say to a Section 8 company, like to an individual is not an issue, but if there is a grant given by the CSR fund to any registered charity, then only 85% of that grant amount will be claimable as an expense. Now, we are still hopeful that the government, I believe Tata Trust and few other foundations have made representations, which was reported in the news. But it's not clear whether that restriction will be watered down or not. Now, the intent behind this proposal was that certain trusts apparently were, just giving onward grants and accumulating 15% at each level and ultimately not spending the amounts. So a simple way to have fixed this would have been to say that the charitable expense will be limited to what is ultimately spent. But right now, it has no correlation to what the recipient actually spends or not. So even if there is no accumulation at the recipient level, you only get 85% of what you have given out as a charitable expense. So if I give 100 rupees as a grant, I only can claim as 85 rupees as a charitable expense. And on the remaining 15, it will not be considered as a charitable expense, and that will create tax consequences.
Okay, Mia, just in the interest of time, one or two questions I want to take on the returnable grant.
Yeah.
The question that if assuming, first of all, you have said that it is legal for the guy to get the money back. So from the 2% perspective, what happens? You get the net value. Is it I gave 100 crores, somebody gave me back 20. So effectively, what I have taken out is 80. Is that the way to think about it from a CSR compliance perspective?
No. That is just you have spent it at the time when you have spent. When you get it back, it's part of your corpus, and that has to be spent out in the year in which it's received.
But assuming it is in the same year, then it's a net number.
Yeah, because then if you receive it in the, let's say I give it in the first quarter, in the fourth quarter, the money comes back in, then that becomes a problem, because I still should have spent out whatever, I've received in that year by the end of that year.
Right. One last question, I think, from Wilfred. Does a returnable grant vis-a-vis a company who has its own implementation agency defeat the purpose of CSR? Could this be a possible means for misuse of returnable grants? Is there anything you want to comment on this?
Sorry, I didn't follow the question. Can we repeat it?
The question is, does a returnable grant for a company which has its own implementation agency defeat the purpose of CSR? Could there be a means for misuse of returnable grants?
So a company who has its own implementation.
I think we can maybe take it later in the interest of time. But let's kind of move. Let's move on from here.
Okay, so impact bonds. I think this is something that we have seen a few at least being considered in a large scale in the market, and one or two have also been launched. Sizes have been getting larger. Now, 2-3 things. This is pretty much, we can say that what we had considered earlier. You have risk investors offshore, onshore. You have outcome funders onshore, offshore. You have implementing agencies, which could be private limited companies or non-profit organizations. So in addition to all the other problems that we discussed, right, here with impact.
We'll just take a small break here. I think lots of people don't even understand this concept of risk investor and outcome funder. So maybe I'll just take a second to explain it.
Sure.
So basically, in a traditional project, what happens? A person comes, gives a grant and tells some organization, please do XYZ. These 100 million students or 100 students have to be educated. This is, I'll pay you 20% here, 20%, 20%, and 20%. Maybe that is a regular structure of a traditional philanthropy. In the case of a risk investor, you say that, okay, boss, I will, as a philanthropic foundation, I will only pay if a certain outcome is reached. If that outcome is not reached, I will not pay. So what happens is, there's a bunch of risk investors who are very deep into that sector. They are wanting to establish maybe theories of change in a particular structure. They understand that space very well. They say, okay, we will come in, we will work with the underlying not-for-profit, we will work with the underlying organizations to create this outcome. And they fund the project upfront. And as and when the outcomes are reached, and hopefully they are reached, then the outcome funder pays the risk investor. The whole idea of the risk investor is to ensure that our philanthropic and development funding moves towards paying for outcomes and not paying for activities. That is the fundamental construct of a risk investor. So at the end of the transaction, the risk investor, obviously, if the outcomes are reached, gets not only his money back, the risk investor may also receive a small return for the risk that he has taken in creating these projects. The whole idea is to move from a situation where we are just funding somebody for doing XYZ activities, putting bodies on the ground. We are paying for a specific outcome. So the outcome may be at least 90% of the people in the class have to get more than 60%. Maybe this could be an outcome. Maybe at least 70% of the people have to have basic literacy. Whatever could be the outcome, then the risk investor has to work to generate that outcome. It may work with the underlying schools, it may work with the underlying not-for-profits. In whatever way they are taking the risk of that particular transaction. And obviously the outcome funder, the risk investor, and the underlying implementing agency have to work very closely together to ensure that a certain outcome is reached. And in this way, you make the whole structure far more efficient by paying for outcome rather than paying for activity. Sorry, Maya. Yeah, go ahead.
No, thanks, Ramraj. So on this one, right, I think we are considering always a mix of onshore and offshore risk investors and outcome funders. Now, some rules of thumb based on the experience that we've had is
maybe Maya, you can take a second to just explain with some, not an example, but maybe in a real world. Let's say we are talking about education. How would this sort of work? So we are trying to solve for a problem. I mean, how would it just maybe normalize this for a person to understand the structure?
Sure. So let's say, as Ramraj said, the idea is to make sure that 100 children pass the 10th board exam, right? That's a verifiable, easy to verify sort of outcome. So now the thing is that you have certain outcome funders who are basically your charities who are interested in achieving this outcome. So they are willing to fund somebody for achieving this, making sure 100 children pass the 10th board exam. Now we have risk investors who come and say, now the people who can achieve this outcome, who can actually train the kids, make sure that coaching is given, take classes for them, are the private limited company and the non-profit organization at the bottom of the structure. But they don't, typically these companies don't have capital. They don't have the ability to, if it's a non-profit organization, you're always looking for fundraising. And so if they go to an outcome funder, typically it would have been a grant that would have been given with the condition that, you take this grant and you try and target this, and we will, monitor how you are on what you're actually doing on ground and how you're achieving it. But instead, what happens in this structure is the risk investors come in and they say that, okay, to educate these 100 children, I will put in 1,000 rupees upfront. I will pay the private limited company and the non-profit organization for achieving this outcome. And when the outcomes are achieved, like out of 100 children, if only 80 pass, right? Then accordingly to that extent, the outcome funders will pay the risk investors a profit. Like if the cost was actually just, let's say, whatever 800 rupees, right? They will pay 10% profit on that. So they will pay the risk investor 880 rupees, depending on what outcomes are actually achieved.
So Maya, what is the private limited company's role here?
Implementing agency.
Okay.
So they are the ones who actually on ground, they are able to conduct classes and make sure that so usually the risk investors can see, and there is not always a need for a pooling vehicle. And as I said, this is one sort of hypothetical way to do it. And there could be direct contracts between the risk investor and the private limited company, or if the risk investor is a non-profit and the implementing agency is a non-profit with FCRA, it could be a direct grant that kind of enables the non-profit to do it. So the form of risk funding can be service fees, can be grants. There could be a pooling vehicle. Sometimes there is no need for a pooling vehicle. But basically, once this money comes in, and then you have to figure out a way, once outcomes are achieved, how does the outcome funder pay the risk investor? Can they do it directly? Does it have to go through a pooling vehicle, or that depends on how the structuring actually works. So in this case, what we have done is there are usually 2-3 options, right? The risk investor assume there is a pooling vehicle for this purpose, and I'll tell you why it doesn't work also sometimes, right? From a risk investor perspective, typically they do equity, debt, or grant, and then once the pooling vehicle receives it, they can give it as service fees or grants to the relevant implementing parties. But one big problem is when you have a CSR entity as an outcome funder, for example, right? A new pooling vehicle cannot be used because you need 3-year track record to receive CSR money. So because of these sort of issues, either you will use an existing entity, or you will see how can it be paid as a service fee instead to the risk investor. And typically from an FCRA perspective, we try to structure offshore payments offshore, and we structure onshore payments onshore. Right? So that's sort of what happens on an impact bond. While it's called an impact bond, I think the one of the ones we launched had about, I think, 25 contracts, which was a mix of outcome funding contracts, service fee contracts, grant contracts, different form of back-to-back contracts to kind of make it work. Some of the other impact bonds we've seen have they go with a template first approach, because see, the more number of funders you have, for-profit, non-profit, CSR, FCRA, and then the number of regulations you have to comply with from a timing perspective also increase. But for a complex project like this, to achieve scale, you also need a certain amount of fund size to kind of be able to pull it off. So there is always that sort of tension between the amount of fund required, and with increasing number of parties, then the negotiation time, the transaction cost, all of that also kind of tends to go up. But in some impact bonds, what we have done instead is we have gone for a template first approach, where you say, okay, this is the template, this is a tripartite agreement or whatever, and this is a service fee, outcome-based service fee contract. Now, whoever can participate in this sort of a structure, only they can, kind of bid for it. So we have seen both sort of approaches, where, in the templatized approach, you kind of have lesser cost, lesser sort of time, but it also restricts the number of, or the kind of parties who can participate in that sort of a structure. The other one which we have on the slide is a bespoke structure, where you line up the funders first, and then you try to figure out what is the best way to do it between them, right? But that is extremely cost intensive, time intensive. It takes about 1.5 years, 2 years to structure, negotiate, and launch these impact bonds. So we have seen a different, variety of approaches in relation to this.
Let's move on, Maya.
Yeah. So social success note, right? This is again, there's some precedent in the market. There is also a more detailed paper on this that's already been published. But very simply put, same risk investor, instead of funding the risk investment through let's say the service fee route or the donation route, here they are actually able to give a loan to the social enterprise, and the social enterprise will return the loan once they have achieved certain sort of certain outcomes. Now, the interesting piece is you usually have a monitoring and evaluation partner who will verify that the outcomes are actually done, and the outcome funder can either structure this as an incentive fee or a grant payment to the risk investor, depending on whether the risk investor is a for-profit or a non-profit. So that's one way to do it. Or the other way to do it is like to have an outcome-based arrangement with the social enterprise. And if those outcomes are achieved, then the payment is triggered, and that payment is used to return the loan. So basically, this outcome-based payment works as some form of subvention of the interest fee or whatever is paid to the risk investor. You could also have instruments where the interest rate also varies, or is entirely sort of brought down to a very negligible amount by the risk investor under the terms of the instrument. and that can be tied to the achievement of certain sort of outcomes as well. So you have that sort of flexibility in this instrument. This works primarily in a domestic context. The second you start doing this in a cross-border context, your ECB and other FEMA restrictions start kicking in.
So this is basically a structure where effectively either the rate of interest or something will be linked to outcomes. And the reduced rate of interest, presumably, which the risk investor may be giving because very good outcome is achieved, will be subsidized by the donor in some fashion, either directly to the risk investor or to the social enterprise.
Correct. Relatively straightforward.
Maya Ramraj, can I just come in here? I think there is a related question that I just thought to this. Can the risk investor here also be a philanthropic or a CSR entity in this structure?
You can, but there are some challenges. It's a bit more tricky if you're going to do it as a non-profit, because you can give it as a loan and you can receive the money back, but whether that qualifies as a charitable expense, etc., will then have to be seen in the context of that entity. Not all auditors are comfortable with that model, but I know there are some non-profits which have been doing such activities for a while, and they've managed to pass the tax audits for many years now. So yes, it's doable.
But the simpler structure would be just to have it as a company, a simple company which receives a service fee for this particular service that it is providing.
Correct. I'm also looking at this as a one-off sort of transaction. There's been some movement on the regulatory side with respect to Section 8 microfinance companies also, because once you go under NBFC regulations and stuff, then you need to have a certain amount of net owned funds.
Yeah.
So NCA and RBI have been flagging, saying certain Section 8 companies should not be doing microfinance. So when I say loan, I don't mean microfinance. So just clarifying that.
Tell me one thing, between this donor and the recipient, channelizing this as a service fee, as you have rightly pointed out, can this be considered a disguised grant when then it entire thing just becomes like whatever income or whatever it is? How does that work? Is there a risk that people will look at this as a grant?
So again, I think this grant or service fees will depend on who's the donor and who's the recipient, right? If the recipient is a non-profit, then grant makes the natural sense. If the recipient is a for-profit, then service fees make sense. But if the recipient is a for-profit, grant can still work. It will be disclosed as income and taxed. Only thing is whether on a conservative basis, do they want to pay GST or not? Because that is really the risk for the service recipient.
Yeah.
For the donor as well. Yeah. So coming to social stock exchange. So I think, see, there are 2-3 interesting things that I wanted to point out. I don't want to get into too many of the details, but as I said, the NSE guidelines first seem to indicate that the instruments listed by the non-profits. See, for the for-profits, I don't think much has changed. It's like listing it on the stock exchange as it would have regularly happened, except you have the additional SSC tag when this instrument is listed, which may help attract more funds. But from a non-profit perspective, 4.0 principal bonds are likely to be considered donations from an accounting principle standard perspective, and non-profits, non-residents are not going to be allowed to invest into these instruments in the SSC, is what NSE has clarified. Now, what does that leave us with? In practice, who can list what instrument, right? If we take bulk of the non-profits, public charitable trusts, societies cannot issue any instruments. So that leaves you with only Section 8s. Section 8s theoretically can still issue any form of debt instrument, right? They can issue non-convertible debentures or those sort of instruments. But that's not really something that's today allowed to be listed on the social stock exchange. But they are also better placed to issue a zero coupon, zero principal bond. Maybe even charities can. But whether that will qualify for tax exemption is something, as we had discussed earlier, based on the documentation, we'll have to take care. Now, the other question was, would private placement, right? By private placement, they're saying that you can issue these zero coupon, zero principal bonds to basically social impact funds. So what is envisaged in that route is that a social impact fund has received money from units, contributions by investors into its units. It can then grant out certain amount, because technically investment into this instrument is to be deemed as a grant. So maybe that's something that there might be some interest in it, but from a commercial angle, which social impact fund is going to be interested in doing that is something we'll have to wait and see. Now, one alternative that we see coming up in the market is also outcome-based exchanges, where instead of listing entity-based instruments, right, like where the instrument listed is issued by the entity, like equity, debt, or these kind of bonds, we are seeing startups experimenting with models where you are listing the outcome itself directly onto the exchange. So this outcome could be listed in the form of ultimately outcome-based service contracts or outcome-based grant contracts, which are listed on an exchange where the outcomes which have been achieved are kind of shown and the impact scorecard is shown. And then the foundations or whoever is interested can go and purchase that, and it will qualify as a charitable expense. So there is some work being done around this as well in the market. The last two we have. So impact fund, again, another version of doing this is instead of the social impact fund, which is category 1.
I think Maya, can we just go back to the earlier one? I think we just had a couple of questions. Can we list DIBs on a SSC platform? One question.
Oh, yes, I missed addressing that. So I think there is some language in the NSE FAQ, which is saying that DIBs being a structured finance product can be listed. But honestly, in my experience, based on what I have explained on the DIBs and what we have seen, it's not a single contract. Typically, it's a combination of, as I said, one impact bond was about 25 contracts, a combination of different contracts. Of course, there's one of the other ones we worked on was a single tripartite, kind of contract structure. Possibly that could be listed, but ultimately these are outcome-based instruments. And I don't see them expressly being mentioned in the rules today, because what we have put in the bullet points, if you see in the rules, the top 3 bullet points on the left: zero coupon, zero principal bonds, donation through mutual funds, any other instruments specified by SEBI. These are the 3 instruments that non-profits can list. Equity, debt, and any other thing mentioned by SEBI is what for-profits can list. So if DIBs are to be listed, I think there is a need for additional clarification or notification by SEBI. And they will have to define what a DIB is for that purpose. But the NSE FAQ expressly calls this out and says it is possible. So
now the other question is whether the issuer actually issues it. Is that like a public issue or a private placement of these bonds? I mean, of the zero coupon, zero principal debentures? Is that going to be an issue, or how is it going to work? So will there be a specific issuance on the exchange, the way today an equity or a debt issuance happens?
Correct. I think where it's listed on the exchange, it is the process seems to suggest that it will be listed like any other equity or debt today, because you have a draft offer document that is vetted by SEBI. You make the amendments and then you put all of this on the exchange, and then it's officially listed, right? And there is the zero coupon, zero principal bonds are for a specific project of funding a specific outcome for a specific period. So if the period ends, or if the then they say it's automatically delisted, and termination of the bond is also considered delisting. Also, they say if 75% of the amount that is sought to be raised has not been raised, then either you will explain where you will get the remaining 25% or return the money. So all of this seems to suggest that it will be listed similar to equity or other instruments on the exchange. Where it is a off-exchange sort of private placement, they say that all of these other requirements will apply except the listing requirements.
Got it. Let's move on.
Yeah,
I think a couple of questions people had asked, we have tried to answer on the social stock exchange. We'll move on to the other structures now. Go ahead.
Sure. So another variation of how an impact fund can work is not using the social impact fund vehicle, which is a category 1 vehicle. Instead, we can try and do something through the category 2 debt fund. Here, what we have done here is that a category 2 debt fund has a slightly more flexibility in terms of the instruments it can invest into. It's not restricted that it has to invest only into social impact funds because you have, social enterprises or ventures, because you have more contractual freedom to determine what your investment policy and all should be. What we have envisaged here as an example is that development finance institutions and impact investors who are okay with muted returns or for-profit investors kind of invest into the category 2 debt fund for units. Now, the debt fund takes that money, pools it, and invests into debt instruments issued by for-profit and Section 8 companies. As I said, Section 8 companies, technically, there is no legal issue today or any prohibition prohibiting them from issuing a debt instrument like an NCD, where they are taking the money and they'll have to repay the capital and interest at a later date. Now, the only thing is and also in the last 2-3 years, there's been additional clarity on how tax treatment of loans and interest paid by, loans taken by nonprofits and the interest payable on it is to be treated for tax purposes. So we also have some additional clarity coming out in this budget as well. So between this, it kind of opens the door for these sort of structures where a Section 8 company takes a debt, conducts activities, ties it to an outcome, receives outcome funding from outcome funders in the form of grants or service fees, and then is able to use that to repay the debt off. And this kind of is easier to do through a category 2 debt fund, because the advantage in doing it through a category 2 debt fund is your ECB regulations and all those minimum maturity period, those restrictions kind of go away.
But you will still, the Damocles sword of FCRA would still be there on the Section 8?
No. So in this structure, what we have envisaged, as we said, so this is being a category 2 fund under SEBI regulations, it cannot accept any grants.
No, not the category 2 debt fund. That is going to give a debt to the Section 8. That is not a problem.
That is
actually the Section 8 has to receive the outcome funding to amortize or repay the debt, right?
Correct.
So
and that we have placed it in domestic entities today. If there is a
understood.
And there could be a question of, even if there's a service fee from an offshore outcome funder, whether it's a disguised grant or not, those sort of questions can come up, definitely.
Got it.
But of course, if the Section 8 has FCRA approval today, then again, it opens up receiving money from offshore outcome funders as well and kind of get involved in these sort of structures.
Is it possible at the debt fund level to do subordination, senior subordinate structures?
No, that I think still seems difficult with the current regulations. And if we have to attempt it, it's easier to do it with the social impact fund and not with the category 2 debt fund.
Okay.
So structured debt obligation, again, is, I think we have seen it in some contexts where we have seen it where a foreign DFI has provided, guarantees to domestic banks who have then given loans against, based on that backing to individuals and social enterprises for achieving certain outcomes. And wherever there is a challenge in repayment of these loans, then the DFI has stepped in and actually made good on that losses to the bank. Now, this enables the bank to sort of give loans at a lower interest or loans to people where the risk could have otherwise been seen as too high or unbankable, or also for a longer period than what they would normally have been able to. Like, I think for maybe some, so typically it's easier to get funding for projects which have a shorter cycle, like agriculture, which has a 6-month or a 8-month cycle, as opposed to forestry, which has a 10-year sort of outcome evaluation period. So
Meya, this social enterprise you have written here, is it structured as a limited company? What is the structure?
Typically it's a for-profit entity.
Okay.
It's not, but sometimes we have seen some non-profits take loans, not necessarily as part of this structure, but the amounts are much smaller.
I'm just trying to understand, Meya, at the P&L of that social enterprise level,
Yeah.
So it will be a Section 8, is it? Because it is going to receive a grant and it has taken a loan, and let's say it has lent money to certain people who have not paid up.
Yeah.
Wouldn't it be sort of liable? I mean, wouldn't it end up paying tax on the grant in some fashion, or you will write off the loan and that's going to be the balancing entry to avoid tax?
No, there will be tax on the grant. So from an income tax perspective, what the judgments say is that if the grant is received for a capital expenditure, for acquiring a capital asset, then it is a capital receipt which is not taxable. But if it is for a revenue purpose or for business operations, then it is taxable as income, but you get to set off all your expenses against it.
So if you have given loans, then and you didn't get it back, then you can write off the loan.
Yes, that'll be an expense. So on any net profit that you make is on what you'll have to pay the income taxes on. The only challenge here is if the social enterprise is a for-profit and the charity is giving a grant to a for-profit, then is the charity comfortable that this is something that they can claim as a charitable expense, and whether GST, whether the tax department will come and say this is actually a service fee you're paying because grants are paid to non-profits. That's the sort of thinking they may come with. So that can bump up the cost by 18%.
And a charity can legally issue a guarantee to a bank. Isn't there any, is there an issue with a charity issuing a guarantee to a bank?
So that's the interesting thing, because there is technically no restriction under law with respect to issuing a guarantee. But when the guarantee is triggered and there is a payment being made by the charity to the bank, again, whether that will qualify as a charitable expense is a question mark. Because we'll have to link it somehow in the documentation to the larger, charitable purpose of serving underserved individuals or social enterprises. So it will have to be really carefully documented to show why it is a charitable expense. And the preferred route would instead, kind of route it, have the charity pay the individuals or the social enterprise and have them repay the loan back. That's still cleaner compared to the guarantee directly being with the bank and the payment directly flowing to the bank.
Okay. And presumably the grant received by the individual, because they are low income, will not be in the taxable bracket. Is that the assumption?
Yeah, typically that's the case.
I think there was one question which we should take, I think, from Akbar Khan. Can an SPV, limited company, provide a guarantee to bank to lend to the social enterprise or FPO, or does it have to be a charity?
No, even a regular company can provide the guarantee. It doesn't have to be a charity. But in our experience, typically the interest has come from the charity angle in this sort of a situation, because they want to, from a blended finance perspective, they want to, instead of giving 100 rupees directly as an expense, they want to leverage and release 1,000 rupees as loans. That's what has driven this sort of a structure. But it's not unusual for even today on the pure commercial transactional side, it's normal for one group company to give guarantee for another group company to a bank against a loan. So I think,
connected to that question, similar to what Ramraj said, can a CSR provide a guarantee to a bank in a similar kind of structure?
Again, there is nothing
there any
CSR law which prevents you, but ultimately when the money goes out, how do we tie it to the Schedule 7 activity and say that this is a charitable expense or a valid CSR expense? I think that's where the documentation will have to be done in a very careful manner.
I think one of the broad questions, Maya, that somebody had, I didn't raise it, was the whole issue that, this is all working in this space of legal opinions. What are the chances that, this is going to get struck down somewhere in a court, in a higher court, saying that, and we've seen that in securitization and some of the other things where people have said, oh, this is not a true sale or whatever it is.
Yeah.
Is that
great question? So I think, let me put it this way, right? So there are on the court side, we are generally very comfortable. See, in structuring all of this, it's not just about, as I said, because of the experience we have had in all of this, we are pushing structures out. Complex impact bonds and other structures are being launched. They are being tested in the market, and there is more legitimacy coming also from the policy side, from the government side. So 2-3 interesting things I'll tell you since we started, doing a lot more work in the space. Couple of years back, Niti Aayog said we should try and do outcome-based financing in the skilling space. We know that there are certain quasi-governmental entities today in the market who have already launched a lot of these outcome-based models, and some of these structures are already live in some form or manner, right? They may not be easy to replicate because of the specific nature of the entities involved or the projects they are in today. But all the track record that they generate, the good thing with these projects is as long as there is outcomes being achieved, that is the best defense you have in a challenge before the court. Because any sort of accusation that you have done something which is not in compliance with the law, you're already in a very good light before the court if you showcase what the actual impact that has been achieved by doing this. And legally also, we have kind of, some of these structures are broken down. There are different pieces of it which are being tested and already have established in the market. Even in the budget speech this year, there is mention of outcome-based financing being piloted at the government level.
Yeah.
So there is some movement. NSE is also recognizing DIBs. There is SEBI has come as a regulator is talking about DIBs and all these structures, outcome-based models. CSR is kind of opening up in the right direction. So I think on balance, generally these structures are becoming easier to do, and there is more legitimacy to it. I don't see court challenge as the biggest problem. As in, like, convincing a court, I think, is relatively easier compared to financing any litigation. I think what we are really trying to avoid is not even to make sure that this is just legally kosher. We don't even want an audit risk. We don't even want tax authorities to go and test this in court because the litigation will cost a lot. Not that we are worried we won't win in court.
Mayor, just one question related to that is that have any of the structures in this domain, I mean, without getting into details, have they been challenged in any fashion at this particular point, or is generally been relatively smooth sailing? I know from an audit perspective, or obviously, audit may have their own views on, they'll obviously want to keep the structure as clean as possible, which obviously, forget the audit part of it, but have any of these been challenged from either from the Charities Act perspective or from a tax perspective? Is there precedence at this point, or generally things have been going well, whatever we've done till now?
Till now, generally things have been going well because industry has also taken an extremely conservative approach. Nobody has tried to do anything which is, and see, some of these, like, for example, some of these structures involve 16 different parties, right? So by the time the structures go out to market, it's not just us who have done it, but it's 16 in-house teams, 16 individual counsel who have all sort of blessed it, tested it, and everybody is comfortable, and only then we are signing the contracts, right? So there is a level of there's a huge level of stress testing that has gone through, and also, to be fair, some of these have been launched only in the last couple of years.
Yes, right.
So while they have seen, it's a good sign that they have seen 1 or 2 cycles of audit. But I think, and to me, that is the trickiest part, because if you're questioned in year 1, your track record is still slightly weak, right, in terms of actual outcomes you have achieved. But if you're tested in year 3, 4, or 5 of the project, there is already some runway to show the good work you have done.
Right.
So I think but once these one cycle of successful instruments are done, I think then we are in a much, much more better place from a policy push perspective, and to go out to market and say, listen, this is done, this was executed, and it was wound up without any sort of legal complication. The bigger risk is not the problems they are facing, the structures in the market, is not the challenges by the tax authorities or regulatory authorities, so much so as the regulations keep changing every 6 months.
Got it.
So to amend and update the structure and to kind of, that shifting sand in the regulations is becoming a bigger pain point than the structure itself being questioned as not being kosher.
Got it. I think there's a couple of last questions. I think maybe, Mayor, you're on the last slide, so maybe we can, you want to go there and yeah. So I think the important thing on this slide, other than Maya's very significant achievement. Maya, just I think you can read this at comfort in terms of his huge body of work. Is the email ID of Maya, which is mayapan.n@trilegal.com. So I think that's the more important one in this. And then obviously his telephone number and other details you guys can note down, and I'm sure you can message him. And if there is anything very specific that someone wants to deal. I think maybe time for a couple of last questions. We seem to have made remarkable time, and I understand that possibly it's been a lot of stuff to absorb in a short period of time. And as you can appreciate, a lot of these, as Maya also mentioned, especially when you have onshore and offshore, and you have risk investor, you have outcome funder, and you have some Section 8s in the middle, sometimes a lot of these structures become bespoke. I think one of the biggest problems of this sector is because it is bespoke, it is not scaling. And the scaling is one of the big issues, because the moment you're bespoke, every time, every bunch of people have to get together and figure out how to make the damn thing work. And our whole effort with people like Maya from Trilegal and others is really to work and try to engage with the government and see, is there a way for us to create slightly more commoditized structures within the ambit of what is possible, so that these can scale. And instead of doing $20 million, $10 million, has to do $100 or a $200 million transaction, which can really benefit many more people. I think a couple of last questions, Maya, before we end. We are just at the end of time. I think Ashim wanted to know, is the trust structure ideal for providing guarantees to banks from a recourse perspective? I wouldn't, you might want to take that one.
I think generally there are 2-3 reasons why in recent times I have on balance just recommended going Section 8 path. One is that you don't have to deal with the charity commissioner anywhere. Secondly, when you look at the newer forms of financing that are coming up now, SSC rules may not be perfect. Other tax changes that come up is also may not be perfect, but I think generally the Section 8 company is a much more easier vehicle to do something like this. Also, a company giving a guarantee and a Section 8 company giving a guarantee seems more easy to compare, even in terms of past precedents, than a public charitable trust, right? Because your obligations, fiduciary obligations, and the way it has been interpreted under trust law is very different from how Section 8s are actually standing on the regulatory footing. So I would say, as a generally, it's better to pivot for multiple reasons to Section 8 company. And for your specific question also, I think Section 8 makes more sense if we have the option.
Got it. So I think we are at the end of the time. Pragya, do you want to kind of just close out the conversation? I had a couple of points to make, but I just wanted to really thank Maya for his, the time he has given, and for all the effort he has taken to bring this to the table. I think at some point over the next few weeks, we will also want to maybe do a smaller private group where there are more specific people who are interested in, maybe considering and evaluating transactions. And, that's something where we can talk obviously in greater detail. As you can appreciate, a lot of these are also real transactions, and we have to be conscious and careful that we are able to place the information that is available in the right context. So please do reach out to Maya for any specific clarifications and any other doubts or issues you have. I really wanted from IIC side to thank Maya, but I guess Vedant will do the honors there. But really appreciate, Maya, you taking the time. I think it was a very, very good discussion. I think we had upwards of 100 people till about last 5-10 minutes. And definitely we will try to bring more such sessions with Maya and with other people, on issues related to this. As I said, this is a complex area. This is a new area. There are intermingling between various issues. We have to work with the law firms, with the government, with quasi-government bodies to see how we can simplify this whole area. Over to you, Vedant, for the vote of thanks on this one.
Thank you so much, Ramraj, and also thank you so much, Maya. In fact, this has actually been our most watched IBFC masterclass yet. So congratulations on that. We got to learn a lot, particularly on the law side, but also how they apply to actual actionable financial structures. I think Ramraj has already like summed up how the session went. We will be sharing like the slides and also the recording in the coming days, and also we'll be touched in terms of like the closed door session. So if you guys are interested in that, keep an eye out on IIC mail. And thank you once again for taking out the time and joining us. And we hope to see you on many more of our future masterclass sessions. Thank you.
Thank you, guys. Thank you all. Thank you very much. Thank you, Via, once again. Thank you.